Hi, my name is Kevin O'Leary from Marvin and Company, a CPA firm here in Albany, New York. We thought with the new tax reform we'd give you a top 10 of what to expect and things that might impact your family starting in 2018 for the majority of them. The new personal tax rates. All the rate brackets come down with the main one at the top, 39.6 is now changing to 37. The Obamacare taxes, net investment tax, and the Medicare surcharge tax are still in play. The deductions, the standard deduction is now changing, basically doubling up to $24,000 for married filing joint and $12,000 for single. Here's where all the press has been with regards to deductions. There are no more personal exemptions. So even though we love our kids and our spouses, they're not going to get us any more deductions anymore. The state income tax, property tax, sales tax, lump them all together. You're only getting 10 grand. It doesn't matter what it's for, how much you're missing out on. The max is capped at $10,000. Mortgage interest expense. I think the main one that you're going to see here is the home equity loan line of credit. The HELOC interest is no longer deductible. And then there's a new floor for mortgages over $750,000. The original floor was $1 million, so if you're over $750,000 on new mortgages starting in 2018, you may have to prorate how much interest deduction you're going to get. The medical deductions. The original thought was that they were going to repeal medical deductions or they were going to increase the floor. They actually went back to an AGI floor of 7.5%, so any medical expenses you have over that 7.5% floor, you'd be able to deduct. Charitable contributions, no really major changes here. They only changed the max, the ceiling up to the 60% of the AGI. The big one here is the deduction subject to the 2% floor. This is a major impact for when you think about salespeople who have a lot of miles on their car, they don't get reimbursed from their employer. All those deductions are now eliminated from the Schedule A. So my advice to people, you might want to talk to your employers about having them reimburse you, setting up an accountable plan, things like that. And one more deduction of note, alimony, which is not an itemized deduction, but alimony for new separation agreements starting in 2018, the alimony is no longer deducted and it's not income to the recipient. So very important that you keep that in mind. The individual mandate of Obamacare, they've repealed it, but the kick here is that it doesn't go into effect until 2019. So for 2018, you still have to have the insurance. Number 4, there's a new section called 199A. You're going to hear a lot about this. This allows pass-through entities, partnerships, S-corps, single-member LLCs, things like that. You can take a deduction for 20% up to your qualified business income. Now there's floors and caps and income limitation, things like that, but you're going to definitely want to keep an eye on it for that. Alternative minimum tax, AMT as it's known, has been eliminated for C corporations. For individuals, it was thought to be eliminated. It's back into the final bill. The floors and the exemptions have been increased. So they're hoping to trap less people in it, but for us New Yorkers, we'll probably still be in it. Estate and gift tax, they've doubled the personal exclusion amount from $5.5 million to basically $11 million. So that's a huge increase for estates. Corporate tax changes, major changes for C corporations. You have now a flat tax of 21%. So no more scales, no more up to 35, flat tax 21%. Section 179 increases to $1 million. Bonus depreciation, instead of 50%, it's 100%. But the only one that's been repealed is the domestic product activities deduction, the DPAD, section 199, that is out. And also one big one here is entertainment has been eliminated. You can still deduct meals for 50%, but the entertainment piece is now out. You really might have to consider now being a C corporation. For S corps, or any LLCs, you might want to think about electing C corp. You have to do the math, obviously. For new entities, becoming a C corporation is now back in play. Especially when you think long-term, selling that stock under 1202, you might get capital gain or tax-free sale of the stock. C corporations that might need financial statements for a bank, you might want to consider your deferred tax issues. You're now going to be recalculating that at 21%. So you might see a dramatic decrease in your deferred tax liability if you have one. But there's also a change to the NOLs, so you might have to revalue your NOLs that you have on your financial statements as well. And the last one is just a warning. There are a lot of gotchas in this bill, so be careful what you do. For example, if you change your divorce agreement for some reason in 2018, you are now underneath the new bill. So be careful that all of a sudden you lose your deduction. With regards to the mortgage interest deduction, if you refinance and increase the debt, you will now be underneath the new law that is enacted. So be careful. Always ask your tax advisor. If you have any questions, you can always email me, kpo@marvincpa.com, or give us a call at 518-785-0134. Have a great holiday. Hope I didn't ruin with this new tax stuff. Bye-bye.